Good afternoon, and thank you for tuning in to the DoubleLine Floating Rate Webcast, hosted by portfolio managers Robert Cohen and Phil Kenney. Before we dive into today's webcast, some notable and upcoming webcasts include the DoubleLine Total Return webcast hosted by CEO and CIO Jeffrey Gunlock and portfolio manager Andrew Su on June 6th. That will cover our Total Return Bond Fund. And on June 13th, the DoubleLine ETF webcast hosted by portfolio managers Ken Shinoda and Morris Chen, covering two of our recently launched ETFs, the DoubleLine Mortgage ETF and the DoubleLine Commercial Real Estate ETF. To register for these webcasts, please visit doubleline.com. Outside of our webcasts, we also produce a variety of thought leadership available on our website. Portfolio manager Ken Shinoda hosts a monthly video series, Channel 11, that reviews market and macro drivers across varied asset classes. We also have two podcasts, the Monday Morning Minutes, hosted by portfolio managers Sam Lau and Jeff Mayberry, which is released every Friday afternoon, covering timely market commentary and macro events for the week, and the Sherman Show podcast hosted by Deputy CIO Jeffrey Sherman and Sam Lau. Lastly, PS Perspectives is a monthly video series hosted by our product specialist team, exploring DoubleLine's latest thoughts on financial markets. These videos can be found on the DoubleLine Capital YouTube page. Moving on to fund offerings, the DoubleLine Floating Rate Fund is offered with two share classes, a retail share class and an institutional share class. Tickers, minimum investment amounts, and expense ratio details are listed on the slide for both share classes. Looking at performance, the floating rate institutional share class has returned 3.7% year to date through April 30th. And on the bottom left-hand side of the screen, you can see the fund's 30-day SEC yield is just north of 9.2% for the institutional share class. And lastly, before I turn the webcast over to the portfolio management team, I wanted to add that Robert Cohen will be appearing on Bloomberg TV this Friday, May 26th at 10 a.m. PST. And now, without further ado, portfolio managers Robert Cohen and Phil Kenney.
Okay, thank you, Colin. Let's jump to a macroeconomic outlook. As you can see here, starting with rates, it's an important part to start when thinking about credit. We're at a point now with the Federal Reserve hiking interest rates since the middle of last year. We see the two-year rates at 4.2% are higher than 10-year yields of 3.6%. So we have an inverted yield curve, and the implication for that in credit is that shorter duration credit assets are highly attractive relative to longer duration because of this inverted yield curve. That's why we think that bank loans or floating rate broadly are interesting places to be now, given the yield backdrop that we have at the moment. What we see on this slide is that while we have elevated Fed funds rates right now, federal funds rate is 5.25, that Fed funds futures project that rates are going to start falling, dropping to 4.4% by January of next year. I don't think, and I think DoubleLine's view is that this is, from a rate cut perspective, a little optimistic. We'll talk about in a minute how inflation remains persistent. And with the elevated inflation, it's unlikely that the Federal Reserve is going to back off of its hawkish stance. And so our expectation at DoubleLine is that the Fed funds rate remains elevated for longer than what this slide suggests. But even if you were to assume that this rate path actually comes to fruition, I think the implication for credit assets is that floating rate assets are still going to be highly attractive, because in an environment where the Fed starts cutting the short-term rates like this, you're still likely going to have a lot of carry in short rates, and it still would make for a very attractive environment for credit, particularly bank loans, even if you shave off, say, 60, 70 basis points from the all-in yield. As we look at further slides, you'll see that the elevated yields provide a lot of cushion, even if this scenario played out. really everything is about this slide, inflation. Inflation caused all the damage to financial markets last year, with CPI peaking at over around 9%, now coming back down at around 5%. Is still quite elevated. The economic forecast suggests that inflation is going to drop back to 2% in an orderly way. Our outlook at DoubleLine is that we don't think that's going to happen. We believe inflation is more likely persistent at an elevated rate. It's very likely that at the end of this year, 2023, we could have inflation in excess of 4%. That is not consistent with the Federal Reserve cutting the Fed funds rate, as the prior slide suggested. It's more consistent with the Fed remaining hawkish, committed to tamping down inflation, and that means higher for longer. And that means that floating rate assets or being short duration is an attractive place to be if we're going to have these elevated rates. Another element why we think that inflation is persistent is because unemployment is persistently low, with an unemployment reading of 3.4%, record low. It's hard to have a view that inflation is going to come down quickly. Low unemployment means strong wage growth, and with wage growth, it's hard to have a disinflationary environment. So the inflation reading, along with this unemployment rate, suggests that the Fed has a lot of work to do. And the only probably real fix for this is to keep hiking until a recession happens. But it doesn't seem that we're on the precipice of that at the moment. We do respect the data. There's plenty of macro data that suggests the economy is weakening. ISM numbers are one of them. The previously mentioned inverted yield curve is another. But just looking at ISM numbers for a moment, when you go below 50, that tends to be coincident with growing recessionary risks. You can see the manufacturing index is already below 50. The services index is still stronger than manufacturing. It's above 50, but you can see the trajectory here is going the wrong way. So the trend is not your friend. If you're looking for macroeconomic data to support the theory of economic strength, ISM numbers are not suggesting that. They're suggesting that the economy is decelerating and that there's a risk of recession as these continue to deteriorate. As I mentioned before, this is the yield curve. This is the 10-year versus the 3-month Treasury. It's inverted. Yields typically invert ahead of a recession. They forecast economic weakness. They don't necessarily mean the recession is imminent. This is a busy slide, but if you can see the red bars, the yield curve typically steepens back or de-inverts at the point of a recession. So while we have a deeply inverted yield curve, it doesn't necessarily mean a recession is imminent, that we're right on the front edge of it. It means that we're on watch for recession and that we would need this curve to de-invert or re-steepen to start to indicate that we're getting closer to recession. I'm going to skip this slide and move on to a bank loan outlook. Right now, you can see that SOFR on the top chart, the SOFR line in red is at 515, and the 10-year yield at 370, this inverted yield I've been talking about, means you're really not paid to go out into longer duration assets. You can see on the bottom, which shows where the red, that's when SOFR is less than the 10-year, which is most of the time. And so most of the time, you're paid to take incremental duration risk, to go out on the maturity spectrum. Right now, that's not the case. You're getting paid to stay short. And that's what this slide suggests, that with this kind of differential of 145 basis points, differential between short rates and longer rates, that being short clearly at the moment is working. And this will work until the point where the Fed starts cutting, which would be when there are clear recessionary signals, which I think is going to take some time. So with these elevated short rates, you can see the black line, which is 3-month LIBOR at 530, and then the yellow line, which is all-in bank loan index yield at 1037. you're getting a lot of base rate and a lot of spread. The all-in yield of 10% is higher than any time since 2009. There's a moment in 2019 when there were elevated all-in yields, but that was a very brief moment in 2019, and then the Fed cut rates and this yield collapsed. I think that we're more likely to be in a period of persistently high rates and persistently high credit spreads, which I think make for a really interesting time in corporate credit. Given that we think that short rates are going to be elevated for some time because inflation is going to be persistent, I think I have the view, and DoubleLine has the view, that this yield on bank loans will persist for some time into the future. I would add that over 10% yield on bank loans gives you a lot of cushion for bad things to happen. People are trying to forecast whether a recession is going to happen. People are trying to forecast what the default rate will be. Let's just propose that the default rate is 5% over the next 12 months, and loans have a recovery of 50%, which is below historical averages. That's a 2.5% yield drag. If you're generating almost a 10.5% return, and you shave 2.5% off that, you still have plenty of yield. Even if that projection turns out to be overly optimistic, there is plenty of yield here to mitigate the risk of weakening economic conditions and default. I'd go even further to say, if you have an outlook that there are recessionary concerns and that you want to move up in quality and you want to have a yield less than the index, let's say 9.5 instead of almost 10.5, you can mitigate the default risk by just owning safer credit. And so that would also be a yield drag. But under that scenario, so-called scenario 1 is a scenario where you have index yield, but you have defaults. And scenario 2 would be you have less than index yield, higher credit quality, so you have less defaults. You're going to have a yield less than the 10.5%, but still very attractive. We're talking about 8-9% yields, depending on how you put a portfolio together and how it moves through time. Still very attractive, even if you account for potential weakness that could occur over the next year or two. This slide is shorter in time series. It only goes back to May 2022. But what it shows is we've been, since the middle of last year, at a persistently high spread level. And there's further slides that help illustrate that. But this elevated spread level is compensating you for potential weakness that could be happening in the economy. I think the next slide illustrates it a little better. This illustrates the relative value between high yield and loans. Typically, high yield bonds yield more than bank loans. They're typically lower in the capital structure, unsecured, and you should get paid for that incremental risk. So high yield bonds are the gray line here, might be difficult to see on the slide. And the blue line represents leveraged loans or bank loans. And for most of the time, the yield differential shows that high yield yields more than bank loans for the reason I just mentioned. They're greater risk. We're at a point now where the yield relationship has inverted, where bank loans are yielding 200 basis points more than high yield, which doesn't occur very often. I think this is partly a phenomenon of the inverted yield curve, where short rates are higher than longer rates, and high yield is more benchmarked off of 5 and 10-year rates. I think it also represents some higher credit risk that exists in loans, which we don't want to ignore, where Phil, who's going to take over in a little bit, is going to show some slides, but double Bs represent about 50% of the high yield index, but a much smaller component of the bank loan index. So a combination of rates and credit risk are the reason why bank loans yield more than high yield. But all things considered, you're getting, as I said earlier, paid a lot to take the incremental risk of loans. 10% gives you a lot of cushion for potentially bad things to happen. And a portfolio that you own over a multi-year period, I think will generate very high returns, even through the cyclicality that could materialize. Just another way to slice the relative value of loans versus other asset classes. Again, a busy slide. But what it shows you is the relative rank of each asset class over time relative to their average spreads. So up at the top would be 100% would represent the widest spread ever for an asset class, and at the bottom, which is 75th percentile rank on this slide, would show generally tighter spread for that asset class over time. What it shows is some of the traditional asset classes, investment grade corporate credit, high yield corporate credit, they're closer to the 75-80 percentile rank, elevated but not at historically high rates. Same with emerging markets credit. And the Barclays Ag is in the 89th percentile. But you see above this dotted line, the areas of the credit markets that have the most elevated yields. And I think they represent a rate effect, but they also represent a level of stress that's in the market. It's no free lunch, but through stress comes opportunity. So bank loans are elevated. I think that that's partly because of a high base rate, high SOFR rate. It's also representative of the credit quality, the preponderance of single B credits, which represent elevated credit risk. And of course, the risk in bank loans are also represented in the CLO market, which is a securitization of bank loans. So you see double B CLOs are above the 90th percentile because of they're basically levered bank loans. And so they represent the same risk that bank loans represent. The other two areas that you see above the line, just for context, CMBS, I think spreads are wide to reflect the concern over office space utilization and the stress that exists from the pandemic work from home phenomenon. And then the widest on this is agency MBS, which is representative of the stress from the regional banking crisis, where regional banks own a significant amount of agency MBS, and they're looking to sell that, which is putting pressure on spreads. But you put that all together, you see that bank loans represent one of the widest spread areas in the market. So whether you have an outlook that's more pessimistic on the economic outlook, certainly if you have an optimistic outlook, then bank loans and these other asset classes are a screaming buy. But I think a more sober way to approach this is to say there are economic concerns on the horizon, there's risk of a recession, but these asset classes, including bank loans, represent a spread level that compensates you for those risks. I guess I'll also end on this by saying that it's very likely that the cycle that we experience now will be different than other cycles. Prior economic cycles since the financial crisis have been represented by rapid drawdowns, a rapid unwind of a great deal of risk taking, followed by the Federal Reserve reducing rates to zero and a rapid recovery. It's very possible that this cycle is going to be slow and gradual in terms of deterioration and spread widening and dispersion of credit. We think that that's an opportunity where up in quality can be great opportunities, regardless of asset classes, certainly in bank loans. One of the best ideas at DoubleLine has been double B bank loans because they have a very low probability of default and a nearly 100% recovery given default, and they yield north of 7%. For lower tiers of bank loans, single B and beyond, there are certainly credits that will survive whatever economic environment we're likely to face over the next few years. So with proper credit selection, it's certainly possible to generate a 9-10% return in bank loans over an extended period. I think this is a multi-year trade, not a trade for the next few months or maybe even the next 6 months. I'm going to end here on page 21 before I hand it off. This shows bank loan performance since 1998. And you can see over time, there's only been 3 years where bank loans experienced a negative return. 2008 is related to the financial crisis, where people had very levered portfolios that unwound rapidly. So you had a very rapid deterioration in performance, which you can see. And then 2022, pandemic year, and unwind of, not pandemic, but the unwind of the pandemic tight rates and the Federal Reserve raising rates rapidly put stress on the market. And then 2015, which was an energy and China growth concern. But typically loans with a high coupon, particularly in an environment now where you have a 10% yield on the index and loans are prepayable anytime, so the good credits refinance and prepay, creates a strong counterbalance to weakness in the market. When you have that high carry and you have assets prepaying, you have the opportunity for very high returns, even in periods of stress, which is what this is showing over a long period of time. That generally you can generate positive returns in loans, even in periods of relative economic weakness. I would just point out 2002 as an example, 2018 as an example, and there are other periods that have been marked by periods of economic weakness where the bank loan market has found a way to generate a positive return. With that, I'm going to do a handoff here to my colleague Phil Kenney, who's going to take over the next section of the presentation.
Thank you, Robert. I'm going to spend a few minutes talking about the state of the bank loan market and some of the trends that we're seeing today. So just to level set, Robert spoke to 2022 performance a little bit, but this shows the performance of bank loans relative to various other asset classes. And obviously, the ag was down 13% last year in what was one of the worst years for fixed income markets in decades. And risk markets also sold off sharply, as you can see from the S&P returns. But bank loans, given the really de minimis duration of the asset class, performed as you would hope they would in a year like 2022 when rates rose rapidly. So far in 2023, loans continue to hold their own. The market is up about 4%. You can see that duration has had a little bit of a rally with the ag and the 10-year both up about 2%. And stock markets are also generally higher. The S&P 500 is up about 10%. The NASDAQ is up over 20%. But that's a pretty narrow range of returns. A lot of it's driven by tech. There are actually only two sectors within the S&P 500 that are positive this year, tech and consumer. The bank loan issuers tend to be smaller in size, tend to be more mid-cap, small-cap companies. So we key off the Russell 2000 more than the S&P 500, and the Russell's up about 2% this year. So in an environment where duration is done okay, and there's a little bit of a risk rally, bank loans are more than holding their own. And that's a function of the yield of the asset class in some of the slides that Robert spoke to earlier. But prices are also a little bit higher year to date. This chart shows the price of the bank loan index going back to the start of 2022. And you can see that prices were down in 2022. We started the year at about 98 and ended the year at about 92.5. And so far, we're up about a half a point this year. So it's been relatively stable from a price perspective. But what this chart really indicates is some of the dispersion that we're seeing in the index. In the green section at the bottom, you can see the difference between prices for double B bank loans, which are the higher quality part of the index, versus single B bank loans. And you can see that that spread differential has blown out to about 3 points. A lot of that happened in 2022. It's actually been stable to a little bit lower this year. But it is notable as an indication that there is something of a risk-off mentality permeating the market. Just to get a sense of the size of the bank loan market, today we're at about 1.4 trillion, which is up substantially from where we were in over the last 20 years. In 2005, you can see we were at about 200 billion. And in particular, the market's grown at a frenetic pace over the last 10 years. A lot of M&A and a lot of LBOs have been financed in our market. And so that accounts for a lot of the growth. And along with that, the CLO market has been growing at a very fast pace. You can see that the size of the market was pretty stable in the early days of COVID in 2020 before rising again pretty rapidly in 2021 in what was a year of robust new issuance. And the size has tailed off a little bit of late. So here you can see new issuance by year going back about a decade. And 2021, as mentioned, was a banner year for new issuance. And then it tailed off in 2022. And the 225 billion in 2022 was actually the lowest level of the last 10 years. 2015 was another time of growth concerns. So issuance was a bit light that year. You can see year-to-date 2023, we're at about 84 billion. which is about the same pace, given that we're 4 months into the year, about the same pace as we saw in 2022. But importantly, as you can see in the dark bar, refinancing volumes now make up year to date a majority of the new issue volume, which is a bit of a change from what we've seen in recent years. Given that M&A and LBO activity has stalled, and given that the new issue market has been closed at points, companies, when there are windows where the market's open, companies have tried to move aggressively to refinance near-dated maturities. So that accounts for the high refinancing volume this year. Here you can see the investor base of the loan market through time. CLOs are the dominant buyer of bank loans. Today they make up about 70% of the market, up from about 40% in 2010. Hedge funds, distress funds, high yield funds tend to participate opportunistically. So they were active after the global financial crisis in 2010 and 2011, and then their participation tailed off. They're starting to come back into our market a little bit. We're seeing some indications of that, but not in a material way so far. And you can see that CLO activity over the last 10 years has been robust. In particular, 2021 was really a banner year for new issuance. It leveled off a little bit in 2022. And year-to-date CLO issuance is down about 12% from 2022. But this shows issuance through the first 4 months. The last several months have been a little bit weaker. And that's because the arbitrage of CLOs, which is effectively the cost of CLOs to issue debt relative to the income and the yield that they receive by investing in bank loans, that arbitrage has been reduced in the last few months. And so that's caused CLO issuance to slow down. And that's something that we're watching closely, given the importance of the CLO buyer base for the bank loan market. So as mentioned earlier, companies have been trying to refinance debt to the extent the market is open to them. And they have made some progress in pushing out their near-dated maturities. You can see that loans maturing in 2023 and 2024 have been pushed out to a significant degree. And companies have had some success with 2025 and 2026 maturities. But the reality is there still is a large step up in debt coming due in 2025. And we think it's going to be difficult for companies to refinance all of that, which is to say we have an expectation that default rates are likely to rise as a result of the 2025 maturity wall. So turning to the credit statistics within the bank loan market and some of the fundamentals we're seeing, we'll start with earnings growth. As you can see, this slide shows trailing 12-month EBITDA growth, which dipped negative in the early days of COVID before bouncing back very strongly in 2021 and into 2022. You can see that in the last few months, last few quarters of 2022, growth did start to tail off. And I think that's better illustrated in this chart, which is from Bank of America about a month ago. You can see that quarterly revenue and EBITDA growth started to slow down as we got into late 2022. And this was before first quarter earnings were reported. But you can see here their expectation that revenue and EBITDA would continue to move lower. And I think their expectation was consistent with consensus, which was also consistent with our internal expectations. We're now basically through first quarter earnings season. The large caps have almost all reported. Most of the small mid caps have. At the S&P 500 level, EPS growth was down about 1%. And we don't have the final statistics for our asset class, but we expect that earnings growth was likely slightly negative. I would say that market expectations going into the first quarter were also very negative, perhaps more negative than actually came to fruition. So broadly, it's fair to say that companies met or exceeded expectations. The overall leverage level within the bank loan market is not in too bad of shape. As you can see here, the latest stat we have is that total leverage was about 4.8 times, which is actually below a lot of years pre-COVID. On the other hand, if you look at the right chart, you can see first lien debt relative to EBITDA. We've seen many more loan-only issuers in the bank loan market because the bank loan market has been one of the marginal sources of capital over the last 10 years. We've seen growth in the number of companies that raise money in our market, but not other markets. So they're just raising money in the bank loan market. The number of loan-only issuers has grown from about 360 in 2012 to over 1,000 today. And as a result, more of their leverage is coming through the first lien level. And you can see that first lien leverage is not at extreme levels by any sense. We're still below where we were in 2020, where we're the same level we were at in 2018. But it is somewhat elevated. And as a percentage of total debt, first lien debt is also quite high. So to the extent that first lien debt is higher, that has a potential negative impact on recoveries in the event of default. Interest coverage shown here is in a reasonably good shape. Interest coverage is defined as EBITDA over cash interest. So this is really an indication of a company's ability to make its interest payments with internally generated cash flow. And you can see we ended 2022 at or near the highest level we've been at for the last 10 years. And a lot of that's a function of the low interest rate environment, which kept interest payments low, even though overall debt remained somewhat elevated. But if we look quarterly, interest coverage is starting to trend down. And this is no surprise, again, given that more of our market is comprised of loan-only names with floating rate debt, a larger percentage of total debt. As short-term interest rates rise, that flows through to interest payments more quickly. This is in contrast to the high yield market or the investment grade market, where a lot of borrowers were able to term out maturities with low priced fixed rate debt when interest rates were low. And so we expect that over the next few quarters, interest coverage is going to continue to look worse as higher interest continues to roll through the annual financials. But given that the Fed is likely on pause, at a certain point, this should stabilize at a lower level, so long as EBITDA and earnings remain stable. So with debt somewhat elevated, interest coverage moving lower, earnings moving lower, rating agencies have become more aggressive in downgrading names within the bank loan market. You can see in 2021, there were many more upgrades than downgrades following the raft of downgrades we saw in 2020. But that flipped in 2022. And for the year, downgrades exceeded upgrades, and that's continued. It's actually, the pace of it has actually accelerated. And so the upgrade to downgrade ratio today is below 0.5 times. And downgrades have actually now exceeded upgrades for each month out of the last 12 months. And so obviously, to the extent that ratings are downgraded, that means that the agencies are expecting the default rate to move higher. But there's also an impact in the secondary market because CLOs are disincentivized from holding lower rated assets. And so they may choose to sell bank loans that have been downgraded. It's not uncommon to see a name downgraded and then for the loan to sell off several points in the secondary market. And you can see that most of the downgrades have been concentrated in the lower tier of the rating spectrum. You can see single Bs and triple Cs really account for the predominant share of downgrades that we've seen in 2023. And so that, again, I mean, most companies that default are rated triple C, sometimes single B, often not double B, triple B. So to the extent that the lower quality issuers are getting downgraded, that's an indication that default rates are likely to move higher. And part of the reason that the lower rated cohort is seeing more downgrades is just because it's a bigger part of the market than it historically has been. You can see here that single Bs accounted for about 45% of the market in 2013 and are over 60% today. And by contrast, double Bs were also started the period about 45% and now are about 30%. So this slide is an indication that the quality of the bank loan market has gotten worse over time. And part of that is because of the growth in the CLO machine. We have been the marginal provider of capital during that period. And if anything, this slide understates what's happened, because the lower quality cohort within single Bs, the B minus category, has grown fastest of all. That B minus loans started the period at about 6% of the market. Today we're at about 24%. So all of this feeds into the default and recovery expectations that we have. Here we see the distress ratio, which is an indication of the percentage of loans that are trading below 80. Typically, when a loan trades at that kind of discount, the expectation or the probability of default is elevated. And so this is a good forward indicator of at least the trend for future default rates. And you can see the distress ratio was well in check during in 2021, early 2022, but as risk markets sold off, as interest rates rose, this cohort of the bank loan market sold off in tandem. And you can see the distress ratio peaked last fall about the time that equity markets bottomed. And it remains pretty elevated today at about 6%. So another indication that there is performance dispersion based on quality within the loan market. And so that feeds into the default rates. You can see that default rates in 2021 were near zero, at or near historic lows, and they've been rising pretty consistently since then. At the end of April, we were at 1.3%. And in May, we've seen a number of defaults. There was a period, a 2-day period last week when 7 large companies defaulted. And that was the first time we'd seen that happen, that number of companies default in such a short period of time since the financial crisis. So if you incorporate the defaults that have happened in May, the trailing 12-month default rate would be more like 1.6%. And if you took the last 3 months and annualized that, the default rate would be more like 2.6%. So yeah, this continues to move higher. Most market strategists think that we will settle in at a default rate in the, call it 3 to 5% area. Long-term default rates for bank loans are about 3%. Over the last 10 years, the average default rate has been about 2%. And we think it's likely that we move to and likely past those levels. So defaults are only part of the story in credit losses. Losses are an interplay between defaults and also recoveries. And one of the key selling points of bank loans is that loans have collateral. We have first lien security typically, which is to say that when a company files for bankruptcy, first lien lenders need to get paid back in full before junior creditors or equity holders receive any recovery. Almost all the market is first lien. There is a small cohort that's second lien. It's about 3%, so it's relatively small. But overall, this supports the notion that bank loans should have higher recoveries than, say, unsecured high-yield bonds in event of default. And this slide is from JP Morgan. You can see the average historical recovery rate for loans has been about 64%. But we've been running below that level for some time. Actually, we've been below that level for each of the last 8 years. And in the LTM period, we're at 46 cents on the dollar. If you look at second lien loans, they're at 37 cents on the dollar. So, this is a function of a few things. I've mentioned before the growing number of loan-only names. So that's part of the story. Higher first lien leverage. That's part of the story. We've also been through recent periods of where when issuers come to market, they have weak credit docs, and so to the private equity owners in particular are known to be aggressive, and they continue to be aggressive. And to the extent they can extract value from troubled situations, if the docs allow it, they will do so. And so it's a key focus of ours here that when we underwrite credits, we go through all of the credit agreements to understand our protections. But that's also part of the story here as well. And loan-only issuers, as you can see, are also a big part of the story. The recovery for loan-only issuers is about half what it is for loan and bond issuers. So as loan-only issuers have grown to about 3/4 of the market now, that has a real intangible impact on recoveries. So turning to the floating rate fund, I'll spend a few minutes speaking to some of the credit stats and some of our outlook here. To start with, we wanted to give an update on fund liquidity. We know this is top of mind for investors in open-ended mutual funds that invest in bank loans. So we think of our liquidity in two buckets. The first is trading liquidity, which is our ability to sell and monetize loans to meet redemptions if needed. And we really make a point to invest in names that will actively trade in the secondary market. We tend to shy away from names with small tranche sizes. You can see that our investments in loan tranches below 500 million are about 4% of the total. And our average position size is less than 2 million, which makes it relatively easy for us to sell names to generate cash to the extent we need to for redemptions. On the settlement side, bank loans can take some time to settle, for trades to settle. And so we're prepared with multiple layers of liquidity. We maintain a base level of cash at all times to meet redemptions. We also have a small bucket of highly liquid bonds. And then we have a fund-specific credit facility of $50 million and a DoubleLine umbrella credit facility of $725 million that we can use if needed. It's worth noting that the fund has been around for over 10 years now. We've been through multiple periods of market stress, market dislocations, and we've never had an issue meeting redemptions. So turning to the fund characteristics, currently the fund has just over 300 issues. Market value is about 200 million. The average price of loans in our fund is just under 95 with a weighted average life of 3.8 years and a de minimis duration. Looking at credit quality, we've really made a point over the last year or so in particular to high grade the portfolio. We've been selling names that we think have elevated credit risk. And so our single B exposure is now below index. Within single Bs, our single B flat and B minus exposure is also below index. Our triple C exposure is below index, and our double B exposure is at parity with the index. You can see the cash balance at month end was about 10.5%. The asset mix is largely floating rate bank loans that comprise 85% of the fund. We have a small bucket for high yield bonds, which is currently about 3%. This is to manage liquidity in part, but also because there are times where we see interesting opportunities within the high yield market. And we have a fully built out high yield team to take advantage of those opportunities when we see them. Similar story on the investment grade side. We have an investment grade team, and sometimes we think those issues are attractive. We also maintain some investment grade exposure for liquidity purposes. In the past, we have had small allocations to CLOs, but we've now taken those to zero, and we don't currently have any equity exposure. The fund doesn't invest directly in equities, but there are times where we can receive equities in restructuring situations. On a sector basis, the largest sector within the index is software. That's also our largest sector. We focus on software names that have high recurring revenue, high customer retention for products that are difficult to rip and replace. We also want to be in end markets that are growing. Our second largest exposure is hotels, restaurants, and leisure. And this is right now still a beneficiary of the post-COVID recovery period. There's been a trend towards demand for services, demand for travel, and these companies are beneficiaries of that. On an issuer level, you can see our top 10 issuers tend to be concentrated in higher quality names or names where we have deep conviction. And then lastly, this shows the Sharpe ratio of the fund over time, and you can see that the risk reward has been favorable, in particular over the last 5 to 10 years. We have a focus on generating returns while minimizing, understanding and minimizing downside risk. We have a fully built out team and a fully built out process that we follow where we underwrite every name that goes in the portfolio to understand every salient element related to it so that we can risk manage the fund and make sure that we are investing in names where we have conviction. We like names that have high enterprise value relative to their debt load, so durable enterprise values, high multiple names with well-contained loan to value, And we think that this process and this approach should help us to optimize returns while minimizing risks through market cycles. So I'll take a pause there, and I think we can turn to some of the questions that have been asked.
Yeah, I'll take one. I assume we're good on audio here. The most interesting question I find is someone who asked or commented that Jeffrey Gundlach earlier in the year indicated that bank loans were one of his least favorite asset classes. So why are we talking about this? I think that's a question we should address. When Jeffrey talks in public forums, he's speaking about asset classes, and he has to generalize, of course, in very public settings. I think his observation, which is the same as ours, which is that down in quality loans, just like down in quality in other asset classes, are at risk as the economy deteriorates, particularly weak, let's say B3 rated bank loans that have high leverage to start. That's why they have a B3 rating. Their interest expense has increased materially as SOFR's gone from effectively 0 to over 5%. And then they have other stresses from margin pressure and so on. I think some of those credits are certainly going to default. However, Jeffrey Gundlach has also pointed out that BB bank loans, so the upper quality tiers of credit, are an area that are uniquely attractive. And so we're in a moment where credit selection can yield very high returns, but asset class allocation can be quite dangerous because some of these asset classes have risks. And if you're just going to make a beta allocation to an asset class like bank loans, then you're at risk of this deterioration. However, the up in quality part of bank loans, particularly, let's just talk further about BBs, as I mentioned earlier when I was my part of the slide presentation, you can generate 7 to 8% returns with very minimal default risk. Phil Kenney just showed you the Sharpe ratio that we generate over time. And so we think this is a moment in time where the asset class has problems that we are not going to sugarcoat. DoubleLine has spoken about other asset classes like CMBS or the agency mortgage market that has problems. But when you get a sufficient discount and you get sufficient yields to compensate you for that risk, there are opportunities. And so while we recognize that there are problems in the bank loan market and the default rate is likely going to rise, in that environment of stress, the higher quality credits within the asset class provide very attractive opportunities, particularly with the all-in yields, like I've been speaking about, where you can generate 7, 8, 9% in very high quality assets. To jump to another question about, I'm going to take a favorite of mine and then I might hand it off, and that's about private credit. So private credit has been a growing sector of the credit markets. A lot of private credit is simply capital that is available to finance credits that have been in the syndicated bank loan market. And it's simply the difference between mark-to-market and non-mark-to-market. So I guess pick your poison. The overlap between the bank loan index, the leveraged loan, the S&P LSTA leveraged loan index, which we manage to, and private credit portfolios, the overlap is very high. In the majority of the cases, they're the same names that are floating between the two markets. One market is not mark-to-market, the other one is. I would suggest as spreads widen and prices fall, which is where what we're experiencing right now, public markets provide an opportunity to get a level of discount and a level of yield that is challenging for the private markets to compete with. So it's just a matter of whether you want your volatility hidden in a non-mark-to-market asset class, or whether you want the liquidity and the transparency of the public markets. I think both can coexist. They serve different purposes, but certainly I think both are going to continue to exist over time. Maybe I'll hand it off to Phil to talk about sectors.
Yeah, I mean, I think we spoke to sectors, with high exposure to software. we like to be in defensive sectors that are less prone to cyclicality, where the earnings can be maintained through the market cycle. So historically, we have gravitated to software and healthcare, and then I mentioned that we also have a high exposure to hotels and leisure, given the COVID recovery. That's an area where we're seeing pretty robust earnings growth and outlook, even as the economy has been weakening. So we tend to try to have balanced credit exposures, but also to make sure that within each sector we're owning the names that we have the highest conviction in.
Okay. I think just one more question to round it out. It's about recession and how do we think about funds that'll perform well in a recession or if there isn't a recession. Clearly, if a recession happens, then the longer duration assets will perform best. So up in quality, where the credit spread is the lowest and the duration is the longest, would be the products that would perform best when we have a recession. As I said earlier, I think that it's very possible that we have kind of a gradual deterioration of economic conditions, in which case it's very possible that we don't have this clear drawdown. We could be in this period of heightened economic uncertainty and capital market volatility for some time, in which case it's hard to make a big call that one product will perform better than another. At DoubleLine, one sort of trade that we like for the environment we're in is to pair credit risk, like the floating rate fund, with longer duration assets like treasuries, so you can sort of hedge yourself and make money in both environments. So in an environment where we have the economy still strong and earnings remain robust, and we see an environment where defaults remain low, you can get to carry bank loans, and then your treasury portfolio really doesn't help you very much. And then in an environment where you actually have a recessionary conditions come to fruition and you have true economic weakness, your bank loan portfolio would be potentially at risk at that point, but it would be offset by the treasury positions, the long duration. So that's a trade that we tend to like and have recommended to investors, is this pairing of credit risk and long duration treasury risk. Those pair nicely in this environment. I think we will pause. I think that's all for now. So I'm going to conclude the webcast for today. We want to thank everyone for their continued support of DoubleLine, and that's all for now. Thank you.